is such an exciting day between Christmas and New Year's. Good morning. Welcome back. This is Bloomberg Surveillance on TV and radio. Tom Keene and Jonathan Ferro are both on their road trip through the British countryside looking for the tots. Evidently, they haven't found them yet. Matt Miller and Kailey Liza, combined, both of you are here with us, which I'm so glad to say. And let's get a look at that incredible action in markets. Kriti Gupta of Bloomberg, really lay it out for us. It's really quite a dramatic morning.
Yeah, very dramatic, to the point that the Stock 600 across the Atlantic is unchanged. That's how exciting it is. So you are, I would say, seeing a little bit more action in the U.S. And I think that outperformance is actually crucial here because, of course, there are still some macro stories. This one coming out of Asia, the idea of what would a Chinese reopening actually look like. And I would argue it's creating a little bit of a defensive bid in the market. Take a look at what NASDAQ 100 futures are doing. They're outperforming, even given on low volume, thin liquidity, all that holiday jazz. It is actually outperforming the S&P 500 futures to the tune of about 0.7%, whereas futures are up for the S&P 500 only 0.4%. So let's see if that holds into the opening bell. Of course, Tesla is going to be a big part of that story as we start to see a rebound of that particular stock in the pre-market. But it's not the only thing moving this morning. As we talk about the China story, the oil story becomes more and more relevant. Of course, you have NYMEX crude, I believe, trading with a 77 handle. But for our radio audience, I want to look at a broader chart of it, not just crude on its own, but crude relative to the bond market, specifically that 10-year yield, because at the end of the day, if you are worried about COVID, if you are worried about a kind of deja vu of 2020, it's going to show up in the bond market. It's also going to show up in the crude market, and they are going to be moving in sync. And that's a trade that's very similar to the idea of the Federal Reserve as well. If you are worried about the macro risks, you are going to likely see a bid into the bond market as opposed to yield higher, oil higher as well. Regardless, they are moving in tandem for the past year and likely to continue to do so in 2023, which brings the question, where does the dollar fall into all of this? Because if yields are higher or lower, the dollar is likely to follow as well. This morning, actually, broadly lower. And this is interesting because some of the biggest contributors to its weakness, actually, once again, coming out of Asia, specifically the Japanese yen, the biggest contributor this morning, stronger by about 0.5%. This comes after the BOJ continues that bond buying scheme. And of course, the Chinese yuan offshore, I should say, is also stronger against the dollar, really part of that reopening trade as well. What isn't is the Aussie dollar. That's where you are seeing some weakness. And once again, that's following the commodity trade, Lisa, down about 0.3% against the dollar.
Kriti Gupta, thank you so much. And especially as Kriti was talking about oil and bonds, there is this question of whether we now have the back to bond trade. It doesn't make a whole lot of sense to me, Kailey, in some ways, because inflation over, is that just basically back to the way that we used to trade this?
I don't think inflation is over. We're still talking about 7%. I feel like there needs to be a delineation made between inflation cooling and inflation cooling all the way down to a 2% target for the Federal Reserve. We are still so far away from that. And the market really seems to cling to any further softness in the inflation data without thinking about how far still that leaves us to go.
We, I think, also have to focus in on the credit cracks that are showing up. There was a great story on the Bloomberg about this as distressed debt is ballooning to levels that are beyond what we saw in the financial crisis. So I think it's important to focus in on that, even as so many, sell side strategists tell us it's time to get back in.
Well, it depends on where, too. And we can go into the differentials between some of the riskier credit and some of the less risky credit. But let's get a sense of that, and especially with the bond story and whether they can really offset the risk in stocks once again, sort of the return, the resurrection of the 60-40 portfolio. Cameron Dawson, Chief Investment Officer at New Edge Wealth, joining us right now from a very cold Florida. It looks like you are freezing in a basement in a place where we're going to count on our orange groves to try to make it through the frost. I'm curious, Cameron, from your perspective, whether you buy into this resurrection of the bond trade kind of idea, despite the reopening of China and despite the potential disruption of yield curve control in Japan.
Well, we think we have to be pretty careful. It's not just a blind buying of bonds, because as we've seen over the last week, there is still upward pressure on bond yields, mostly as you have that China reopening, which could cause some inflationary problems to reemerge in 2023, but also because we have better U.S. data. And if U.S. data continues to be resilient and the labor market continues to hold up well, what that means is that out-year pricing of cuts of 50 50 basis points in the back half of 2023, which really put downward pressure on some bond yields. As those get wound down and we see the pricing of the Fed staying higher for longer because the economy is stronger, that would put upward pressure on bond yields. And then if we think what that means from a credit perspective, we don't think we've really priced in a recessionary scenario into credit, which means that if we do see kind of a weakening in the economy in the back half of 2023, it means that at today's credit spreads, we're not really being well compensated. So we think all in yields, there's still places for opportunities and we can lock in those yields, but you have to be very selective as you're building up fixed income portfolios.
All right. So